Now it says it's streaming live.
Yeah, I'm seeing. Okay, I think we're good. Well, we're not quite there yet. Okay.
Yeah.
I think we are live now.
Yep, that looks like it.
Awesome.
Now it says it's streaming live, and we can hear myself back. That's a good start. Okay. Well, thank you, Angus, for that. And to anybody watching, apologies for the delay there. But we are now live and we're good to go. So I'll just jump straight in with sharing my screen. No, I won't. I'll start off by sort of introducing myself. So thanks particularly to the Futures Conference for inviting me to speak. And thank you to Angus Stewart here for helping me get this set up. My name is Alex Everett. I'm an investment analyst and a trainee portfolio manager, junior portfolio manager at Cameron Hume. We're a fixed income investment specialist based in Edinburgh. And really what we offer is various fixed income services, including macro investment, ESG investment, and various different solutions for insurance clients in the bond space and using derivatives to meet the needs of our institutional clients. That means that we are dealing primarily with pension funds, with insurance companies, etc., etc. And a really key part of our business strategy over the last 3-4 years in particular has been the really substantial growth in ESG, which is environmental, social, and governance issues. And so part of what I wanted to do today was just explain a little bit about how that works in the fixed income sphere, how that fits into my role in the investment team. And also, I think at the request of the organisers, to touch a little upon how I've got to my position right now. Now it is 5 o'clock on a half sunny, half rainy afternoon in Edinburgh. I don't want to completely bombard you with charts, facts, and dry conversations the entire time. So I understand that Angus will be taking questions on my behalf at the end of the session. Please do save as many of those up as you fancy. As I just said, the bulk of my talk will be on ESG with a particular focus upon climate risk, because that's something that our clients really take very seriously. Equally, I sit in the macro team, so if you want to talk about the US election or Brexit or some combination of both, or how fixed income works or how asset management works, I'm really happy to do that. It's now 5 minutes past 5. No, it's not 7 minutes past 5, close enough. I'll be talking for maximum half an hour. And as I said, please do fire your questions at me. With that, let me just share my screen. I've got a PowerPoint to come up, if that's okay with you. Angus, do you mind just confirming you can see that full screen, please?
Yes, yeah.
Great stuff, thank you very much. So everything I just said, and basically I'll be, as I said, the key feature of this particular set of slides is climate investing in fixed income, but I'm more than happy to chat beyond that as per the questions you ask. So let's move on. You will all be familiar with the hockey stick of carbon dioxide emissions, which has grown exponentially, using that word deliberately, across the last 20-30 years. This chart is clearly not that, but what this chart is showing is the, frankly, very broad and uncertain range of pathways that may or may not result as of climate change in any capacity. And what's happening here in this chart from ourworldindata.org is it's showing the relative different potential temperature pathways on average in relation to the emissions which we as a collective Earth world civilization emit. As you can see, particularly in this scenario of no climate policies to mitigate, this is a very widespread. And it's worth pointing out, even the best outcome of 2 degrees, 1.5 degrees is a significant change to various civilizations, parts of the world, because that figure is on average. So if you're going to the deserts or the tropical areas by the equator or the extremes of the poles, they'll be dealing with probably the worst of this. Others of us, for example, in Scotland, in more temperate climates for the most part, it may not hit quite so seriously, but at the end of the day, these are all quite significant changes that are going to hit lifestyles, livelihoods, businesses, etc., etc. And which of these pathways actually transpires is really a function of the international coordination or lack thereof between governments and various international bodies such as the UN, etc., and how they can basically come to some kind of shared conclusion and set of decisions to guide us on a lower emissions pathway. Now, my job, my colleague's job, is to manage investment portfolios on behalf of institutions, most of which are dealing with time horizons that are 30 years, 40 years, 50 years, 60 years. Our investments may not be that duration, that length of time, but we're trying to preserve capital and meet their capital growth requirements over that period of time. And that means that we have to do our best job possible at considering what any of these different pathways might look like in a portfolio context and how we can adapt for that. What's really quite important is we can't just focus on that bottom set of 2 degrees, 1.5 degrees pathways. We have to be ready in a portfolio context for any of these options. So with that, I'll move on for a second. Let's just have a quick delve into that international cooperation piece that I just mentioned. The chart in front of you is showing a range of familiar countries where on the x-axis we have the carbon dioxide intensity of the energy used by these countries on aggregate. And on the left-hand side, it's a measure really of how much energy is required to produce $1 equivalent of GDP. And what I'm going to really highlight to you today is the United Kingdom down the bottom left versus Ukraine on the bottom right. And in easier terms, rather than just this chart, what we actually have a situation is that Ukraine uses 5 times or thereabouts the amount of carbon per dollar of GDP equivalent than the UK. But what's not on this chart is what you can probably guess. The United Kingdom's GDP is 5 times or thereabouts that of Ukraine. So the actual carbon emissions output of the two of them is pretty much the same. So if the objective in just that 2-country scenario is to reduce global emissions, yes, you could say to Ukraine, please go and make your GDP more clean, your energy output more clean. You could also say to the UK, please suppress your overall GDP, which, by the way, actually is amounting to saying, please have your individuals having a lower quality of life for the most part. What you can probably guess is that neither of those things are going to happen. And I picked a fairly polarizing example there with Ukraine and UK, but anything that's outside that central belt on that chart, there is scope for some change, but the reality is it's probably unlikely to happen anytime soon without intervention or assistance. Each country is on its own pathway, and without the international agencies agreeing, working together, trying to have a shared conversation, then what we end up with is a situation where we're probably on one of those higher pathways on the previous slide rather than the lower pathways. It's all quite doom and gloom so far, but there are ways out of this, don't panic. So let's move on. Just going to briefly, and I mean briefly, touch on what this looks like for bond investing. Now, apologies for those of you who for this is really, really familiar. I'm just going to delve into what really a bond looks like. When you are investing in a bond, what you're doing is you're lending to someone, something, whether that's a country, whether that's a corporate, or anything in between, various supranational agencies and similar. The amount of money that they pay you to compensate for that, the interest, should really be a reflection of how risky that borrower is. In other words, how likely they are to pay and how able they are to pay. Now that could be impacted by a whole load of different factors. For example, the length of time you're lending for, what kind of regular liabilities that corporate or that nation has, the political scenario surrounding the country or the corporation, the liquidity of the bonds in question, etc., etc., etc. And what we really end up is that the additional compensation for a riskier borrower is what's called a larger spread. And as I'm hoping you gathered in the way I'm talking here, is that the more risky a borrower is, the higher the spread should be for the most part. And there are many mitigating factors which I won't go into right now. Now, what this chart shows you here is the extra spread which a poorly ESG rated company pays versus a highly ESG rated company pays. And so we'll come back to what each of the line means separately in a second. But as you can see, at the beginning of this year, March, April 2020, during the COVID-induced crisis, what we had is that the cost of borrowing pretty much across the piece grew. The spread was wider, and we measured that in basis points, i.e. hundredths of a percentage point on the left-hand side. What it get back to is as we come back to July, August 2020, around about now, this is back to really a matter of tiny numbers of basis points. And what we're saying here on this whole slide is that the additional cost that poorly ESG rated borrowers have to pay to borrow is not a lot higher than that of well-rated ESG borrowers. Just bear in mind that the colors represent credit ratings, in other words, independent assessments of, as I said already, ability and willingness to pay. The ESG ratings add another layer of support to that analysis, which basically says you've covered your liabilities, you've demonstrated that you're financially able, perhaps at AA1, the highest rating. But if you haven't got your ESG factors in place, perhaps there are other reasons why you may not be quite so suited to be lent to. And again, the overall message here is that the additional cost to borrow, despite having poor practices around your climate risk readiness, around the way in which you treat your workers, etc., is not very high. The spread premium for poor ESG risk management remains low. That means, in the context of this presentation, is that if you're not managing you as the borrower, whether you're Shell, whether you're the United States, whether you're the United Kingdom, etc., if you're not managing those risks very well, you're not really paying very much because you're risky. That's a gap, and it might come back to bite bondholders at some point in the future. So what do you do? Let's move on. Disinvestment is something which is really commonly talked about, and to some extent it might feel obvious. We know that tar sands are extraordinarily intensive to extract the energy, and it is commonly seen as something to completely avoid at any opportunity. Thermal coal is a very efficient source of energy for producing energy, but if you're actually going to use the overall carbon budget, that's not the right way to go. Yeah, overall, fossil fuels are indeed the principal source of carbon emissions across the entire value chain. It's worth bearing in mind that 30% of annual global greenhouse gas emissions actually do come in the production of energy, heating, and other sort of fuel. Therefore, you could say that if you pull out of these clear carbon producers, then in that case, you're doing something good, right? You're solving the problem. Maybe not. I'm going to jump straight actually to the disadvantages rather than dealing with some of the advantages, because you've probably got where I'm going with this. The reality is that fossil fuels quite literally fuel the entire global economy, or a significant portion of the global economy now. And if you are in your investment portfolios to suddenly deny funding, whether that's equity funding or fixed income funding, then immediately you're acting as though you think the whole world can transition to renewables tomorrow or right now. I don't really need to tell you, as the audience behind your screens, that's not entirely plausible. Second problem is that you can easily, in inverted commas, apply pressure to the oil majors who are borrowing. They're listed on the international equity markets, the FTSE or the Dow or whatever other else, or perhaps they're major bond borrowers. It's quite straightforward to go out on a big public statement that you're not going to lend or not going to buy equities from these companies. What it does instead is says to the national oil companies, those for example in Saudi Arabia, in Venezuela, in Russia, you've got free rein of the market, do what you like. And there's significantly less oversight in these scenarios. That's the transition funding point at the bottom, that actually the companies such as Shell, such as BP, such as even ExxonMobil, who have advantage from cleaning up their act quite literally, if you take away funding for them, you're not actually facilitating that transition. And I won't dwell too much on this, but this slide is produced from data from the Transition Pathway Initiative. And what they try to do is say, look, if we as a collective are to meet the lower temperature changes on my first slide here today, then actually these companies, for example, in the oil and gas sector, have to reach this level of emissions below some technical numbers which the Science-Based Data Initiative have produced behind the scenes. And the key point to notice here, and I picked out a couple of quite major oil and gas producers you will have heard of: BP, Dutch Shell. One you might not have heard of, Cheniere Energy. I'll come back to you later on. The only one that actually has forecasted far enough out for these measures to have any kind of bite is Shell. And that's Shell in the maroon red dotted line. And at the moment, they are due to just squeak under the Paris pledges, i.e. a set of agreements made about 10 years ago, I believe, by 2038. And as you may have seen in the press recently, they're making quite substantial efforts to meet net zero by 2050, which is what these are trying to achieve, and also to generally accelerate that shift into renewable energy. What they've done is make a clear commitment. This, of course, is subject to the risk that other aspects of their business become very unprofitable, very much possible. Look at the price of oil this year. It's subject to an unfriendly regime they operate in. It's all well and good that the UK government has just announced this, well, the Conservative Party has just announced this week that they really wish to pursue a green future. Shell's an international company. They work in areas which may be less friendly for their new initiatives. It's a bit of an unknown. But I think at this stage, what is clear is that Shell, in contrast to the rest of its peer group, has made this visible commitment. And the Transition Pathway Initiative is an independent source, independent think tank who works in conjunction with a lot of science backing. And I think this data does speak for itself to some extent. Let's move on. So I've alluded so far to what you might do in a portfolio. And what we've kind of got to as a few conclusions is that, particularly in the bond market, which is where I sit at the moment in terms of how I'm investing with my colleagues, when you're lending to corporates in particular, the premium you receive back, the compensation is not high enough to reflect the risk taken. We also know that to transition, to adjust company structures to meet a less carbon intensive economy in the future will be expensive. And an expensive transition is a worrying sign for a bond investor, because what that really suggests is that they're going to come next year, 5 years time, 10 years time, and say, we'd like to borrow more. Now, yes, they are asking the broader market, but that is likely to see the initial cost of borrowing increase. The value of existing holdings decrease. So what we've done in one of our portfolios, I'm talking here about the Hume Global Fixed Income ESG Fund. The name's on the tin. And what we do in that fund is really pursue overall good management of ESG issues across the piece. As I already said, carbon emissions exposure is a really important part of that. And at a fund level, the net carbon emissions exposure in the fund is lower than that of its benchmark. And that's actually demonstrated on this chart in front of you. On the left-hand side, gross exposure is the exposure which comes out of the general business activities. We've weighted that by holdings. And you'll see that the fund has got, and this is in the open column, has got, apologies, the fund is in the green column, not the open column. The fund has got lower gross emissions exposure on the left-hand side. Then you've got mitigation, which is the negative column in the center. What the given company is trying to do to offset. That is, as you can see, we've got more mitigation factors in the dark green in the center. Put them both together, and the gross exposure minus mitigation ends up with an overall much lower figure. Tick, on a weighted basis. Now it's worth pointing out here that this is not just our wording that you've got to take our word for it. We use the internationally recognized data from MSCI ESG, and this we think is a really important part of the way in which we can speak to clients, to regulators, to our own board, and confirm to them We're not just saying we're doing something, but we are actually achieving it. I'm aware I'm rattling through this, so please do keep your questions ready for the end, and I can come back to these slides. Very brief, I don't wish to overload you, brief insight into how that's done. All these dots represent bond issuers. In other words, companies who do seek to borrow money on international bond markets. And a given issuer may have many bonds out at the same time. So I don't know the exact numbers, but let's pretend that Shell has 20 bonds available. Some of them will be very short term, 2 years, 5 years. Some of them will be very long term. And the amount of money that Shell pays to borrow that money will vary. Some of them also will be denominated in euros, in US dollars, in pound sterling, and maybe a few other currencies, and perhaps Japanese yen, for example. But it's worth pointing out that the key bond markets are denominated in US dollars with a little bit of, relatively little, very large amount in euro and GBP. Now, there are lots of colors. That is intentional. What we've done here is taken a deeper dive into some of that MSCI data. On the x-axis, there is gross exposure or materiality. How much carbon emissions impact upon the business and the future business of one of these companies. On the left-hand side is how will they deal with it, how will they manage it. And we've color-coded that by quartile. So the top 25% is in green, bottom 25% in red, go figure for the rest of it. And what I've probably hinted at quite strongly so far is that despite being an oil major, despite being a current net overall very large emitter, Shell manages, or at least is beginning to signal its management of the risks arising from carbon emissions very well. Not only have they committed to net zero by 2050, not only have they just begun a set of quite painful restructuring to achieve that. Last year, they, in quite a sort of high profile way, they left the US lobby group, which includes ExxonMobil, Repsol, other. They'd all been lobbying the US government to reduce the caps on emissions. Shell felt that that was no longer something they could support. So they stopped supporting it in frank terms. And what this really means is that we, my colleagues and I, see Shell as a bit of a guiding light. They manage the risk well, and they're setting a good example for their peer group. That is in complete opposition to Cheniere, who you may not have heard of, but they're a liquefied natural gas producer based in southern Texas. Now, they take 100% of their revenues from LNG, and they have publicized pretty much zero intention to change this. In fact, if I just quickly whiz back, Cheniere is that blue line, which is almost looks like a mistake on the chart. The data has not been provided to the Transition Pathway Initiative to allow them to forecast forward. That in itself is a bit of a warning sign. They're not taking this required transition seriously. So Cheniere are at the very bottom, or near enough, in the quality of their management of carbon emissions risk. So we mentioned divestment already. At this point, I'd question you or anybody else, what's the point in just excluding Cheniere? Not only do you, when you wish to exclude, I already talked about the funding issues. If you're happy to fund the transition of high quality managers, what are you saying to those on the bottom who you don't wish to fund, and why? What we've been building into portfolios recently and having some really productive conversations with clients is you could just say, I will not lend to you, or we will not lend to you, if you don't get yourselves out of that bottom quartile. What that does is it gives the company something tangible to work on. It's measured by an external agency, as I mentioned, the company MSCI, and there's always a bottom quartile. As soon as something, let's say Cheniere really cleaned up their act over the next 6 months to a year, they might get themselves into the third quartile, perhaps even the second quartile. Somebody else takes their place. So therefore, if you wish to be lent to at a sensible price, you will be hopefully continuing to strive to manage that risk well. Now, this is kind of early days in the way we're looking at this, but what's quite nice about fixed income portfolios is you can get away with excluding that bottom quartile without significant impacts upon the return profile of the fund. I won't get into that quite right now, but I'm very happy to take questions later on. But what we're finding is that this is something which the clients we talk to are able to basically defend. They can go to their own clients who would be pension holders across the world often and say, look, we're taking a stand here. We're not just saying not that company. We're not denying the transition as a whole, but we are setting a minimum requirement about what should be done in recognition of the overall climate risk position. So that is hopefully quite a brief overview about some of the different ways of treating climate risk, particularly in the context of fixed income portfolios. Before I wrap up, I'm just going to switch tack completely and highlight why I'm here and what asset management looks like as a whole. So I keep coming back to the fact that we are, one, fixed income investors, and secondly, we deal with institutional clients. There are many different ways to do asset management as a whole. You'll all have heard of BlackRock or Standard Life or others. They tend to be a bit larger, much larger, multi-asset houses. So they'll be managing equity investments, real estate investments, fixed income investments as well. Hume, we are a very small company and we specialize in fixed income. And our approach really is what we would offer a closer client service. What you may wish to know as a potential asset manager yourself in the future is the range of roles that are involved. So on a nearly daily basis, I and my colleagues, both on the actual investment side, but on the analytical side and the operations side, we're talking to investment banks. We're talking to exchanges who sit in the center and deal with cleared instruments such as futures and other sorts of things. Research companies, the clients who could be individuals or institutions, like I mentioned already, and investment consultants who act a bit like a gatekeeper between us and the clients to review the funds that are available and to basically provide an additional consideration service for the end client. It's not just about managing money. I'll be quite upfront. During my graduate scheme, the first 3 years of my career, I spent a significant amount of time working in operations and middle office. That was actually really good fun because I talked to a lot of different people across the world quite a lot of the time, helping understand why trade flows didn't work out, helping get Hume's data in. In fact, the ESG data I mentioned already, part of that process of getting it into the company was my effort. Clearly, there's a significant amount of marketing effort that goes along. There's a significant amount of conversations, going out on the road and explaining some of the stuff I'm saying today. Various avenues to take. No surprise that ESG is a fast-growing focus, and a lot of the job descriptions and job advertisements are really relying upon that as something to at least talk about, if not be a key part of the role itself. That altogether suggests that there's no particular degree you have to take. In fact, many places really prioritize different degrees. And particularly in Edinburgh, despite the relative consolidation, in lots of the firms buying each other up, there's definitely a strong focus on that. Data is just a requirement. You don't necessarily need to be able to do Python, SQL, R, or Stata, however you pronounce it, but having at least an understanding or an interest of one of those, or one or two or three of those, would be really helpful. And an absolute minimum, you've all have heard this, but basically be as proficient as you can in Excel. I don't just mean doing your accounts every week or whatever. Particularly, I'd point to being really comfortable with lookups, with pivot tables, manipulating data to produce charts and similar. It sounds a bit easy, but actually even Microsoft PowerPoint, don't roll your eyes too much, but to create a good PowerPoint does take quite a lot of time. And if you hated this PowerPoint, I'm sorry, but the overall point there is that all this stuff does come together to present a good picture. Finally, just on the CFA, the Chartered Financial Analyst curriculum, it's quite broad-based. So you do 3 exams, each of which are 6 hours. It's not the most pleasant experience. And you have to do at least 4 years of work experience before you can receive your CFA charter holder status. This gives you a complete wide crash course introduction into equity management, fixed income management, accounting, behavioral economics at times, blah, blah, blah. well, other things. But what's really important to highlight is that ethics is a really key part of the CFA curriculum. What they're trying to achieve is to anybody who's a CFA charter holder is not just competent, but can be relied upon to have a kind of attitude to investments where the client comes first, where there's fair dealing, and where you're really not just doing, but representing an improved approach to investment as a whole. And that's something that the CFA Institute is really keen to offer and indeed promote. So I think that is really the end of what I plan to say in the more presentation-like context. In that case, Angus, I hope there are lots of questions, so please do fire them through. And if they're not, we'll just wait and see.
Awesome. Well, thank you very much for that presentation. That was very interesting. I particularly found the bit about excluding the bottom quartile and sort of creating a competitive sort of environment for different companies to sort of improve their practices. That was quite interesting. Yeah. So we do have a couple questions. I guess I'll start off with a COVID question. Do you think COVID crisis would accelerate ESG investment, or do you think companies are now more cautious about investing into ESG given the uncertainty that the pandemic has sort of introduced into the economy?
And I could probably spend another hour trying to pick apart bits of that. If I do keep it as short as I can, ESG, which I never bothered explaining what it means, but I know most of you will know, environmental, social, and governance issues, is a very wide range of potential factors that it covers. And I think particularly where COVID's concerned, it's the S and the G. And we'll come back to the E in a second. But on the S front, that ends up covering how corporates of all varieties treat their workforce, how their relationships with unions work, and how not only are they good at it, that's a little bit too puerile, but are they doing so in a sustainable fashion which reduces the risk of lawsuits, which actually fosters a culture where people wish to work and can work without future health issues and all that kind of similar stuff. So I think it's quite obvious that when you look at, for example, companies such as Boohoo with the issues around their employment practices in Leicester, and that list goes on, so I won't spend too much time now. It's coming to the forefront of the way people view what a company should operate, like how they should operate. And then that comes back to governance. Governance is one of those words which can mean many things, but it's effectively the way the senior managers at a given company take control and manage out those issues over the short, medium, and long term. And so to some extent, you can argue that G is the whole picture, because good governance is something which also means you're taking your environmental exposures, risks, and opportunities quite seriously. Personally, on the E front, I think that's the one thing that COVID hurts a bit. If you look at the amounts of plastic, disposable, perspex screens, even just masks you see lying around on the streets, that has probably been a setback there. But I've already said that ESG is not just about risk as an opportunity. I know, can't think of the names off the top of my head, there are various companies who are working on more sustainable ways in which to manage COVID risk well in an environmentally conscious way. What, of course, you have to bear in mind is that could also be expensive. And as any investor has to do, you have to figure out, is there future growth or is there a future risk to debt repayments because of this very honorable, but perhaps unsustainable in the financial term strategy? And that is a balancing act. Finally, we're all doing this on Zoom. I don't know about you, but I literally hadn't heard of Zoom until February, March this year. Yet suddenly it's not just conferences that take place, it's not just family things that take place using Zoom. The number of business calls I've had based upon this, I've attended a couple, I think it was Goldman Sachs, where they had hundreds of people. I'm sure there are hundreds of you on this now as well, by the way. Hundreds of people from across the world signing in to hear so-and-so person speak. This plus Microsoft Teams, blah, blah, blah. It's all accelerated because of COVID. And that, compared to the struggling airline sector, it's promoting a change. And I probably could have summed up that entire answer by saying it's accelerated change. So I'll end on that one.
Awesome. And I guess there's so things to consider as well with, I guess, with as we transition to more digital stuff. I guess you also have to start to question sort of even the carbon emissions of technology companies like running data centers and things like that. Is there a lot of focus on that right now, or is it more focus on like the companies like Shell and ExxonMobil who are sort of heavily involved in fossil fuels?
That's a really good question. I think people, the broader public, which then trickles through to the investment community, see Shell, ExxonMobil, the oil majors as an easy win because it's something they can grab onto and shout about. But you're absolutely right. As we're all relying more and more, not just on using technology day by day, but trillions of gigabytes, terabytes of our data sat there somewhere, whether it's held by Facebook, by Google, by Amazon, or Apple, they hold most of it together. That is, as you rightly point out, Angus, a growing concern. I'm actually drawn to the example of Microsoft. I think a couple of weeks ago announced the early results from some trial to keep some servers underwater where it's colder, and therefore they're not paying so much in the way of cost for cooling. Clearly very expensive and risky to keep servers around water. But I think the early results that look actually, if that technology became more widely available, therefore cheaper, then actually the overall cost could quite plausibly become lower in terms of actual money out and clearly better for the environment. Having said that, I have no idea what that looks like for marine biodiversity when you've got big chunks of metal sitting around in the sea. But again, it's a balancing act.
Awesome. There's some other questions. Do you think there needs to be more regulations implemented in the ESG sector? There's a lack of universal industry standards for ESG metrics. Yeah.
Yes, in short, but I think that is happening present tense. So I didn't really mention, but I perhaps should have done, bodies such as the UN PRI, Principles of Responsible Investments, and the likes of the TCFD, the Task Force for Climate-Related Financial Disclosures. That's quite hard to say. One of the many things those types of bodies, and there are many more, are trying to achieve is unification, both on disclosure from the corporates and the sovereigns. And as you already correctly mentioned in this person's question, achieving unity and some better comparability of metrics. Right now, it is quite open. It's one of those things. I watched a webinar the other week. It's quite easy to say that's rubbish because it's not yet decided how it should be done. You could also turn that into something positive and say there are so many ways that people are trying to solve this problem. They are taking their own opportunity. As we all get more familiar with ESG as a concept, as a traditional investment factor, which I think we are trying to do at Cameron Hume, then over time they'll become a bit more bonding, as in linking up of the different definitions used. A common question we get asked, I sort of lead onto it, is the fact that, for example, the data from MSCI is their opinion, their qualified opinion, but it's their opinion. Sustainalytics do a lot of data on something very similar, and Bloomberg do their own ESG ratings, Fitch do their own ESG ratings. One, why? Secondly, why they're different? And I think that really, I've answered that question already, and they all go in their own ways, but it's up to us in the investment community to sit in the center, try and tease out the most salient points from all of them, but also keep an open mind, because the reality is that nobody's going to be exactly right. And as ever, in any kind of investment, you are taking some risk, and your best bet is to sit in the center and try and compile everything as well as you can.
Awesome. I guess I just have a slightly separate question. So you mentioned sort of the governance of companies and how you treat employees. At first glance, you would imagine that companies who did that would sort of outperform. So it sort of begs the question as to why there are still companies that exist that don't treat their employees well. Is there a reason why companies are not shifting?
Good question. I should carry out that I have no data to back up what I'm about to say, but I'm thinking as I go along around why that is the case. The reality is that a bit like with the insurance industry and people who take risks and then don't start again, reality can get away with it. And I think, at least in the short term, some of these industries that have treated their workforce poorly, some of these industries that have not taken it seriously, and indeed some companies, not just industries as a whole, up till now, they've not been exposed, or they've, sadly, in certain cases, particularly abroad, have systematically throttled the voices of those who may have complained about it. Number one, that is changing. And I think there's a significant increase in people's ability to talk and to spread a message more widely. Now, clearly the likes of Twitter and similar have been around for a lot longer, but I'm certainly seeing over the last year or two, activism via those kind of platforms seems to have grown. And so if you've got a viral campaign in the sense of activism rushing through and reaching people's the forefront of their minds, then that's likely to lead to change. Also, the investment community as a whole is very diverse. It's not just managers like ourselves who talk about putting ESG at the forefront of the investment decision. There are many managers across the world who frankly couldn't care less. The regulatory regime varies quite substantially. When we talk about equities, anybody near enough off the street can come along and buy an equity without any kind of issue. So you do have quite a diverse range of participants who may be propelling some of these less sanitary companies and less sanitary practices. Hope that answers your question.
Yep. No, that was good. And then I have another question. So this investing in or like encouraging companies to sort of transition away from sort of, I guess, CO2 or towards sort of greener technologies, would that sort of affect maybe different groups differently? Perhaps like developing countries may get affected if they don't have access to, coal and things like that, or maybe affects developed countries more. Is there like different effects for different people, and maybe could you list some of the effects for them?
You kept me busy there with kind of list the effects. So the short answer is yes, there definitely is a range of opportunities and issues to resolve depending on where in the world different companies operate and the industries in which they do it. And just if I quickly jump back to the Transition Pathways Initiative slide, the big colorful blocks as opposed to the lines, they're what I mentioned are the science-based targets data, where they basically take the common standards for a given industry on average and say if overall this industry followed this pathway, then the 2-degree pathway could be met. Below 2 degrees could be met. I've plotted data here from the TPI, Transition Pathway Initiative, just for oil and gas. They've done one for technology, they've done one for aeronautics, they've done one for the electrical utility sector, etc., and so on. And so I guess the point there is that they are recognizing that each industry has to respond differently. And then by extension, where the individual companies sit globally and the way that different bits of infrastructure operate has to be treated differently as well. To try and add a bit more legs to your question, Angus, as well, if we look at, for example, South Africa. South Africa is not a wealthy country anymore. It may have been at times, but combination of economic factors and geographical factors based on climate, heavy water issues in Cape Town you may have come across, and then the way in which they've really struggled to keep a lid on their currency depreciation, etc., means that they're really quite unlikely to be able to commit the substantial investment to change their very CO2 heavy energy infrastructure. So that's why they're on that right-hand side on the x-axis. See, carbon dioxide features really heavily in production of their mix, energy mix, whereas wind power or solar power, etc., does not. Who's going to pay for that? The reality is it's not easily going to be the South African government. I think it was either this year or the year before, they were re-rated as junk borrowers, which means they're sub-investment grade. That was by the Moody's credit rating agency. That is not only does it sound bad, but it means that South African debt, South African bonds, are no longer in international bond indexes. So that then means that passive bond funds are not just buying them because they're in the index. So suddenly, a significant amount of flow and appetite for South African debt drops away. And it's really economics 101, supply and demand. If there's no demand there, then they're going to really struggle to actually issue at a sensible price. The cost, as in cost to the end client of buying South African debt drops, the yield has risen, they're paying more. So I hope that comes some way to answering your question, Angus.
Yeah, no, absolutely. That was good. And some final questions about sort of your work. So what are the most challenging aspects of your work? Was a question asked. Yeah.
Interesting question. I think for me, it's trying to cover a million different things at once. So as I mentioned already, I sit in the macro team, and I'll be quite frank, it's a bit easier to just focus on the key markets of the US, the UK, a bit of Europe. And that probably means you're missing opportunities for us in the investment grade space by not looking quite so heavily at Norway, at Sweden, at Australia, at New Zealand. Now, I'm not trying to sit there and say that we don't do that, but your kind of natural gravitational pull is towards the markets you think you understand. And particularly with the US, UK, and Europe, they're also much busier markets. So the impact of economic data on jobs, or the latest interest rate policy decision from the relevant central bank, that does move markets more. So again, their gravitational pull sits there. So I think one of the most difficult things for me is to remind myself to keep my mind and therefore options open. And bear in mind that to make any money in any kind of investment opportunity, you're trying to find something which you believe is undervalued, or if you're shorting, overvalued. To do that means probably digging around a little bit more than just the obvious stuff that comes up.
Awesome. And then I guess one other question is, do you have any advice for, I guess, penultimate year students that are looking to maybe trying to figure out what to do or how to get into perhaps what you're doing now? Do you have any advice for them?
So your best bet, and it's easier said than done, is to find yourself some tangible work experience. And if you're penultimate year, you're probably either looking or have got one or are seriously looking at internships. And I'd clearly encourage you to get the best out of those if you can. If you haven't got one, don't panic, because I think, especially given the way the employment environment is right now, or at least as we get into the next year, there'll probably be a bit of a shakeout in the lower tiers of companies, which is unfortunate. But if they're looking to potentially offload some full-time hires at the junior levels, then they might need some temporary 2 or 3 months type employees. That's a bit of a roundabout way of saying it, but basically, if you can find a role that is at least semi on the way towards what you'd like to do, that's great. From my own experience, as you probably gathered from that right-hand side set of boxes, I did investment banking as my internship. I'm not doing investment banking now. But what that demonstrated is not only a set of skills, but an appetite to work, and as you may know, put quite a lot of hours in for investment banking. Secondly, it's a bit of a signaling thing, sort of on the softer side of the economic point of view. by the fact that you've been employed on an internship basis by somebody else, a reputable firm, that immediately signals to the person you're applying for another job that you're at least semi-reasonable. No, I said that with a little smile on my face, but look, if you're hired by a reputable firm elsewhere, you can't be a complete lunatic. You must be quite qualified. You've already got your degree points of view, and it's that little bit extra. So it doesn't need to be an investment bank, of course it doesn't. But if you can demonstrate that you have put your neck out there, got some skills from it, and are hungry to learn more, tick.
Awesome. Yeah, I think I don't have any more questions, and I think we're almost out of time. Yeah. So do you have any sort of closing comments that you'd like to say, or otherwise we can, I guess, end the stream?
I guess I talked quite a lot, so I suppose I'd just really say thank you all for listening to me today. I hope you found it interesting. I have touched on quite a bit, so if I can provide any more color on any of the concepts involved, please let me know. You can find me, where can you find me? Probably best on LinkedIn. So it's Alex Everett, that's EVERETT. And as I said, I'm really happy to chat further on what asset management and fixed income looks like, any career, not advice per se, but sort of help through. And yeah, that's me. Thank you very much to Angus and to the Futures Conference team for the opportunity.
Awesome. Yeah, and we really enjoyed having you on. So thank you very much for your time. And yeah, everyone watching, thanks for watching. And